Short selling serves as the financial system's primary error correction protocol, yet its structural complexity is often obscured by emotional or moralizing narratives. At its first principle, a short sale is a collateralized loan transaction integrated with a directional bet. The process involves borrowing a security, selling it at the current market price, and holding the cash proceeds as collateral. The objective is to repurchase the shares later at a lower price to return them to the lender, capturing the price delta as profit. However, the short seller never gains title to the asset. They function simultaneously as a borrower, a depositor of cash collateral, and a counterparty to a recall risk. Unlike a long position, timing is a critical dimension here. Being fundamentally correct but prematurely positioned is functionally equivalent to being wrong, as the position can be terminated by the lender at any moment. Furthermore, the mechanism provides a vital market function by incorporating negative information into asset pricing. In a market without short sellers, securities become one-way systems that aggregate optimism but fail to reflect pessimism with equal speed, resembling a thermometer that only measures temperatures above zero. This leads to a fundamental misunderstanding regarding risk architecture. In a long position, the maximum loss is capped at 100% of the invested capital. In contrast, short selling possesses an asymmetric loss profile, where the theoretical maximum loss is infinite because an asset's price has no upper bound. A notable example is the 2021 GameStop event, where a short position at $10 resulted in a nearly 4,000% loss as the price surged to $400. This demonstrates that shorting is not merely a negative buy, but a high-stakes bet against gravity with extreme structural risks. The execution of a short sale relies on an institutional supply chain involving four distinct counterparties. First, the beneficial owners, such as pension funds and endowments, provide the supply. They lend their idle securities through custodian banks to earn incremental fees while retaining economic exposure and the right to recall the shares. Second, the prime broker acts as the engine connecting lenders with borrowers. They manage the collateral, charges spread on the borrow fees, and optimize costs through internalization, matching long and short interests within their own client base to bypass external markets. Third, the short seller must obtain a locate before executing a trade, which is a formal confirmation that shares are available. This locate is merely a snapshot in time because the securities lending market operates on an overnight basis. The borrow can be re-rated or recalled daily. For instance, Beyond Meat saw its borrow fees jump from 34% to nearly 200% in just 3 days in late 2024. The fourth component is the clearinghouse, specifically the National Securities Clearing Corporation, which settles transactions on a T+1 basis. When a short seller fails to provide shares, a failure to deliver, or FTD, is generated. This represents a structural defect where a buyer's account is credited despite no physical delivery. The persistence of FTDs, which averaged nearly $3 billion daily in 2025, highlights a significant friction in market plumbing. The cost of maintaining short positions is defined by the borrow rate, the difference between the rebate rate earned on cash collateral and the prevailing short-term interest rate, such as SOFR. While most liquid stocks carry minimal fees, hard-to-borrow securities can reach annualized costs of over 100%. Maintaining a position that loses 4% of its value daily to fees is not a sustainable investment strategy. It is a structured path to insolvency, regardless of the underlying fundamental thesis. Professional institutional short sellers maintain a structural advantage over retail participants through informational proximity and capital architecture. Institutional desks have direct access to real-time inventory data from prime brokers, allowing them to detect tightening borrow markets before the data becomes public. Additionally, professionals rarely take naked directional risks. They utilize pairs trades, longing a competitor while shorting a target to insulate the portfolio from sector-wide volatility. This hedging allows them to withstand mark-to-market fluctuations that would liquidate a retail trader. Their edge is further sharpened by forensic accounting and primary research, identifying structural rot months before it surfaces in consensus earnings reports. However, the most severe systemic vulnerability is the short squeeze. This is a reflexive feedback loop where rising prices force short sellers to incur losses, leading to margin calls from prime brokers. When short sellers are forced to buy to cover to close their positions, their buying pressure drives prices even higher, triggering a geometric acceleration of forced covering. The 2021 GameStop squeeze saw short interest exceed 140% of the float, meaning more shares were shorted than physically existed. This mechanical amplification created a $20 billion loss for shorts. A mirror image failure occurred with Archegos capital management in 2021. Though it involved synthetic long positions through total return swaps, the result was the same. A leveraged position in an overnight funding structure hit a margin threshold, leading to a $20 billion fire sale. Whether the leverage is pointed long or short, the structural vulnerability remains the same. Any concentrated, leveraged position is subject to the mechanical dictates of the clearing system and the prime broker's risk limits. The Federal Reserve directly influences short-selling economics by setting the interest rates that govern rebate rates. In a zero-rate environment, the cash collateral posted by a short seller earns nothing, making the borrow fee the primary cost. When the Fed tightens rates, as it did in 2022 and 2023, the cash collateral earns a meaningful return. This lowers the effective cost for easy-to-borrow stocks, but makes hard-to-borrow names significantly more expensive, as premium fees are layered on to higher base rates. Consequently, short interest has concentrated in large-cap names, while crowded shorts in the small-cap universe have become prone to extreme squeeze risks. The move to T+1 settlement in 2024 further compressed the window for resolving locates and failures to deliver, increasing operational friction. When these mechanisms fail or are restricted, price discovery suffers. Research from the 2008 financial crisis indicates that banning short sales increases bid-ask spreads and degrades price efficiency. Without the immune system of short pressure, overvaluation compounds until the eventual correction becomes catastrophic. For the serious investor, short interest data, enhanced by the SEC's Rule 13F-2 effective in 2025, is a high-quality signal of institutional conviction. A spike in borrow fees or sustained high short interest represents a visible statement that sophisticated participants are willing to pay significant tolls to bet against a company's prospects. This should not be used as a blind trading signal, but as a critical input to test the quality of one's own long-term conviction. Ultimately, short selling is a necessary, albeit dangerous market function. It hunts for systemic infections, and while the cost of deployment is high, suppressing it only ensures that the eventual collapse will be more severe when reality finally arrives. The short seller's presence is the only thing ensuring the market's thermometer eventually reflects the true temperature.